Chance to shape your future is here. Learn and connect with exciting new opportunities. Are you ready for the next step?
Good morning, everyone. Thank you for joining me. And really is a pleasure to be here this morning to tell you a little bit about where money comes from. Just as a matter of introduction, I'm from Maxibat. I'm part of the innovation loans team at Innovate UK. I know a lot of you probably think of Innovate UK as a provider of grants, but we did have some competitions where we were involved with actual continuity loans. I'm going to be talking to you this morning about where money comes from and what we do as Innovate UK as part of the context of the finance markets, both debt finance and equity finance. I'm going to basically just turn my camera off because very soon I might be sounding like a Dalek. So please just bear with me whilst I do that. Oops. Sorry about that. Okay, hopefully you can all hear me quite clearly. Yeah, just to let you know, if you've got questions as we go along, please drop them into the chat box. And Aileen, who's helping out today, she'll make sure that they're there and I can go through them at the end of the presentation. A lot of you've probably seen this, the innovation ladder. A lot of technologists use this innovation ladder. It works through innovation from TRL1 to TRL9. It's also used for the manufacturing readiness or commercial readiness, and so many of you will be familiar with this. However, as you all know, this isn't reality from a technology development point of view. People, when they're thinking of finance, are thinking of a stylized version of this, and I don't think that's really the reality. And very often, people think about this idea of the valley of death, that when businesses are innovating, when they're carrying out research and development, the cash is going out before it's coming in, and there has to be some sort of investment into the business. Smoothing out that valley of death is something that grant funding can do. However, actually filling out that valley of death can be done by external finance. So particularly capital, equity investment in business is really valuable. And when I talk about this, it's sort of this graph and where the funding comes from is presented as a funding escalator. So many of you will have seen this. This funding escalator really looks at where people are starting to get their funding. So in those early days, most of that funding tends to come from their own money, friends, family, and then they get money from the business angels. And as the business grows and develops, it's venture capital finance, and then that sort of post-revenue period, looking at debt finance and private equity. This particular chart, it's quite an old one from Nesta, and I'm sure you've probably seen many others that look very much like this. Now, this is assuming that grants come at the very early stages. Now, I don't really agree with this because of that assumption that the first bit of capital comes in the form of free money and grants. And really, grants are there for stimulating innovation rather than being early stage initial capital. And as I go through my presentation, I'll explain why that is. So just looking at these two pictures, the first one and it's in relation to the that financial escalator. Is it a myth, or is that what reality is like? So this first picture is Canary Wharf, and this is what that escalator really, in that picture form, looks like. It's bright, it's shiny, it's got this lovely linear feel that takes you from the bottom to the top, nice and easily. The other station, which is Canary Wharf, sorry, got my stations wrong. The first one, Canary Wharf, the second one's Westminster, is probably more what getting access to finance is like. There's stairs, there's escalators that you have to go up, go down. You've got to divert to change tube lines. And, if anyone's been in these stations, which I'm sure a lot of you have, is trying to avoid all the people as well. You need to have a strategy, basically, to get from the district line to the Jubilee line. And that's similar with trying to raise finance. So I want to try and help put forward, explain where money comes from, where the different forms of finance fit in, and how to navigate to where you want to get to. So looking at things just within the UK business context, politicians talk about somewhere in the region of 5.7 million SMEs in this country. You'd be surprised to know that most of these have no employees. About 1.4 million businesses in the UK have employees, but only a subset of these are scaling quickly. Some of the numbers here from the Scale Up Institute recently indicated that only around 74,000 scale up businesses are in the UK. And really, those scale ups are the growth champions of the SME. And really surprising is that most businesses don't use external finance. They will put in their own money at the outset. Where they do use external finance in those early stages, it's typically straightforward things like credit cards, overdrafts, loan from a bank, leasing. They don't really get involved with that complex stuff that we at Innovate deal with. So grants for research and development, that equity finance. As you can see from some of the graphs here, of those businesses that sought external finance in the previous 3 years, the sizes, it's very much the medium term businesses that were requesting or researching and getting that finance for R&D. So what support is available for finance? So I think on my slides, it just might have got a bit mixed up, but as today, most external finance is straightforward. This is really where the credit cards, the bank overdraft, leasing that I was talking about earlier. And as you can see, I mean, if we compare 2018 to 2019, that request was much higher in 2019 than in 2018. Don't have the figures yet for 2020, but obviously with the impact of COVID, it will be much, much different. So yeah, what are we looking at? Where is that support coming on for research and development and innovation? So how are we supporting that innovation, research and development and the costs around it? The first really is through the tax relief system. R&D tax relief is there for any businesses that have qualifying R&D expenditure. 50 to 60,000 businesses in the UK make use of this support, and they claim billions in pounds each year. An SME doing R&D can claim about a third of those costs as R&D tax credits after the event, and it's available there from the government. So just looking at some of those figures, back in 2018, 62,095 claims, of which 54,000 were from SMEs. And that had gone down a little bit between 2018 and 2019. But the amount of support was slightly higher at 5.3 billion. And this is very much about covering those R&D expenditure and innovation. So that funding is there for support. So what does Innovate UK do? How do we support R&D? So what we've got available are grants and other programs that we run, as well as the innovation loans. We do that more specialist support. We provide that grant funding for selected businesses, and I think we're quite niche. We'll define specific eligibility criteria for our grant programs and our loan programs, and we'll think about the applicants. We'll look at collaboration, because we believe that's really important for transforming the industries of the future, or to bring in the research base, as well as the larger and the smaller businesses. We'll look at very specific things around the scope of the activities that we support, and which might be very much challenge-led through something like the Industrial Strategy Challenge Fund. It might be sector-focused, and occasionally we do broad-based responsive programs where we're looking for the most innovative project proposals, and we're highly selective in doing that. So, as I said earlier, this idea that grants are the first starting point for raising capital is incorrect. And businesses that think that they're entitled to a grant instead of raising their first round of capital is horribly incorrect. So here's a chart from the Advanced Propulsion Centre, who Innovate work with, and they've identified set stages where availability of capital is particularly difficult for highly innovative businesses in those early stages. Those businesses are struggling to get the next lot of money because the money that they've put in, also what they've put in from friends and family, has run out. So they're looking for external finance. Although businesses that are revenue generating can demonstrate where they are, but that they need funding to scale up. As an example, it might be to put in place a manufacturing process to develop their customer proposition. At Innovate, we have programs to address these. Investor partnerships are for those that at that early stage, in particular, innovation loans for those early stage R&D businesses, e.g. those that are scaling up manufacturing, or putting in place a really solid software platform for software as a digital business. The bigger scale stuff, Innovate UK does not have a specific mechanism to support, but we are working towards this. These are some of the challenges, really, that moving from sort of bottom left to top right, that we're trying to solve as set out by the Advanced Propulsion Centre. So really, there's micro and SMEs with technology, but they're struggling to find scale-up funding. And sometimes these are just at that top pile with the bigger scale. They're too big for normal VC funding, and they need their special funding approaches from those specialist lenders. I just wanted to mention one of the programs that we've got here at Innovate UK, and that's our investor partnerships. What we're trying to do with this is to bring together the grant funding for highly innovative and research and development projects, and using our ability to assess projects, provide funding and stimulate activity, we want to put that together with our investor partners who can look at business capability, they can look at the growth opportunity, and then if that all matches, provide the capital. That alignment of capital alongside our grant funding, we hope will help those businesses that are investment ready, recognising that they need that capital and are doing innovative things. This way, they've got a much better opportunity to deliver the impact that is at the heart of everything that Innovate are trying to achieve. I mentioned earlier the innovation continuity loans. This was a programme that's been running sort of from 2017, where we had the innovation loans, and following the impact of the COVID pandemic, the innovation continuity loans. These have these programs have now finished. Last competitions closed in January, but they were very much tailored for those later stage research and development businesses. They were looking, what we were looking therefore was that with Innovate UK having much more of an appetite to take on innovation risk rather than the traditional commercial lenders, we were hoping to be able to support those R&D and follow-on projects that businesses wanted to take forward, which they probably wouldn't have been able to do if the availability of a continuity loan wasn't there. Though these competitions are closed now, we really are hoping to have something later on in the year, so please watch this space. Okay, moving on to debt finance. So let's look at it in the context of the UK. Most businesses don't borrow money, and many that could still don't borrow it because they're discouraged. It's quite scary to see a stat in the British Business Bank State of the Small Business Market report that 73% of businesses would rather forego growth rather than borrow. So there is that real risk aversion from the business landscape, but also I think there's an aversion to risk from the banking sector as well. So I mean, looking at these figures, which were produced back in last year, 29% of those surveyed expected the Brexit to have a negative impact on business growth. It'd be quite interesting to see how that view may have changed, but bearing in mind where we are in the scheme of things. And also, there are 28% of businesses that expected to grow in the next 12 months. That figure was down from 36% back in 2018. I think, bearing in mind what we've seen so far with the pandemic, it's going to be much, much lower for the coming year. So with debt finance, I've mentioned that banks are risk averse, but what do they look for? What are they after? So, I mean, first of all, who are these lenders that will look at debt finance? Obviously, the high street banks, there's specialist lenders out there, the challenger banks. A lot of fintech companies are coming into the market as well. There's things like peer-to-peer lenders, where the crowds can get together to provide capital. They'll be looking to provide working capital for businesses, typically through overdraft facilities, sometimes through longer term loans. And very often these lenders will want to see and also base their financing on assets. So things that they can physically see. So they may consider things like leasing. I mean, invoice discounting is also another option. Export finance. I mean, looking at providing finance to cover the risk and the payment delays that can happen when a business is exporting is really, really important. So what are these typical lenders looking for? Typically, a strong track record. They want to see 3 years of financial statements if the business has been trading. More than anything, they want to see that demonstration and evidence of success, and particularly the cash flow. They want to know that the business can pay the interest and the capital on the loan when it falls due. And really important, they'll want to see security. If you can't pay the loan, then they can step in and pay that security. It's a bit like a mortgage on your house. If you don't pay your mortgage, the mortgage lender comes in, takes your house and sells it as a way to get their money back. And what with high street banks and some of these other lenders, what they want is just no surprises. They want something to be quite predictable and they can see where things are going. So how's the government supporting the debt finance market? They do support it quite a lot, particularly through the British Business Bank and their startup loans directly to individuals to start a new business. The British Business Bank put a lot of money into the challenger banks, the peer-to-peer lenders, And they also provide guarantees to the banks where collateral from the borrower isn't good enough. And that helps them, that helps that borrower to secure more than they would otherwise. Things like the Enterprise Finance Guarantee Scheme, we've had, excuse me, CBILS, the Coronavirus Business Interruption Loan Scheme. The guarantee from the British Business Bank helped to reduce that risk slightly to the lender, and obviously provides them with that much more comfort. Once again, I mentioned UK export finance, and taking out export finance credit insurance is really, really key, especially with regard to changes and delays in payments and in view of the current market. There's other funds and schemes in the devolved nations, which includes the things that the Development Bank of Wales, the Scottish National Investment Bank, and in addition, they're involved with the regional activities. So as an example, we've got the Northern Powerhouse Investment or the Midlands Engine Investment Fund. There are some specific debt facilities, and what they're trying to do is make sure that there's enough capital to provide access to finance for smaller businesses to scale, right across the country. So looking at sort of the non-bank finance, I mean, I think this is an area that's becoming increasingly important to SMEs. So they're looking at much more asset finance and using peer-to-peer lenders. So, there's been an increase of 14% in the number of smaller business equity finance deals to over sort of 1,600. These figures provided by the British Business Bank, and it's really, really looking at those between 2014 and 2018. Okay. So moving on to sort of equity investment. So what's key about the equity side? This is really the risk capital before the finances are available. And where does that come from? It's for a very few select high growth potential firms, because the investor really wants a strong return on their investment. And up until the start of the COVID pandemic, the UK's equity markets were booming, particularly for early stage equity investment. And you see here, again, a chart from the British Business Bank, and it's showing that the number of deals up to the end of 2019 has gone up. There's record number of deals happening. There's record levels of equity, and particularly into the tech sector, the life sciences, and these are the specialist sectors. Software as a service, fintech, they don't need too much capital equipment, but however, they may be capital light, but they are growth rich. So prove to be very, very attractive to investors. Okay. And looking at finding that right investor, if one thinks of that ladder, and that angels and equity crowdfunding platforms are those early stage, and that you'll probably find that with angels and those equity crowdfunding platforms, that they'll typically invest somewhere in the region of 100,000 to 1 million as a group, not as individuals. The next stage would really be the venture capital firms. They're looking to invest between 1 million to 10 million. And we then move on to the corporate venture capital. So these are the big businesses that want to invest for strategic reasons, and will offer that level of investment. Next, really, from there would be the public markets. And it's often thought that you can't launch into the stock market until you are quite big. But AIM, the alternative investment market, has a high growth rate segment, and you can raise funds from £3 million upwards. So what are those investors looking for? Well, they're looking to take a share in the business in exchange for their risk capital. The business isn't giving away equity, really, they're exchanging their shares for cash and the right valuation that makes sense. Clearly, what those investors are looking for are tax benefits. So things like the Seed Enterprise Investment Scheme, the Enterprise Investment Scheme, the Venture Capital Trust. I mean, they all have tax benefits for investors that will encourage them to make more investment in businesses. I mentioned the strategic alignment in corporate venture capitals, and really what they're after is they want an investment in the business, as well as influencing through the board seat, but actually really as a minority investor. Overall, investors really want a higher return when the business sells. So they'll be looking at that expectation of the return, the timing of that. What's the exit strategy going to be? Where's the business in their growth stage? Really, really important is, what is the quality of the management team? What's the business's value proposition? Is it scalable? Is it defensible? Does it have a defensible position in the high growth markets? So just looking at the support that the government offers around equity, once again, they do provide a lot of support for access to finance. And this is really through the British Business Bank across the whole of the UK. The Development Bank of Wales has a co-fund, as well as does Scotland and Northern Ireland and London, really. So there is a lot of co-investment where private investment is matched with public sector investment to make it all go further. The British Business Bank has got quite a lot of big programs. The Enterprise Capital Fund is a large program looking at putting investment alongside the private sector into venture capital firms. The Venture Catalyst Fund and British Patient Capital. They've also started to look at specific market areas with the National Security Strategic Investment Fund. In addition, they've been doing some specific work in relation to the COVID pandemic with the Future Fund, and they've also got an amazing regional angel program which offers up to £100 million. I understand that the Future Fund has been now extended by a month. I think I heard that in one of the presentations yesterday. So some of these funds that I've talked about are very specifically regional based. And for a lot of these, for a lot of investors, the tax relief side is important. I just wanted to mention the Business Growth Fund. Though it's not a government support scheme, it is supported by the five major banks, looking mainly at growth capital, that later stage activity, and that the Business Growth Fund was put together after the global financial crisis back in 2008. So just to touch on the difference between angels and venture capitalists. So how do they differ? With angels, it's their own money. You might look for a lead angel, and then others might coalesce around that person. And sometimes they'll create an early stage fund, or they'll create a syndicate to offer that funding. They'll take specific risk. They will take specific risk areas that they like, and often they're doing it not just to make money, but they actually want to give back. They can provide you with those specialist skills and experience that can be really beneficial to an early stage business. With regard to venture capital, these firms are typically investing other people's money, so they attract money from high net worth individuals, from institutional investors like the pension funds, insurance companies. They've got a more formal way of operating, and they use investment committees rather than individual decision making. They'll also be looking at more risk mitigation and often not taking part in the tax breaks. The venture capital investment manager, they'll be an investment professional who's paid to make those decisions. They'll tend to have deeper pockets than angels, as Ian said, that it is much, much higher level as well. So, several years ago, Innovate UK went out to talk to investors and some of the minor businesses, particularly about scaling up. And they asked them what they were looking for. With the investors, it was key, and I mentioned the management team earlier, and that is still really vital. That's what they said. That's the focus really. So whereas we in Innovate UK, we focus very much on the project and the ability of that project team to deliver. The investors are looking very much at the overall management team. You know, have they got the breadth, the capability, the passion, and the drive to grow that business and to scale the business? On the bottom right, we actually asked both the investors and the businesses what they thought the other side was looking for. Investors were looking for communication, adaptability, resilience, and chemistry. And I think that the businesses that we spoke to actually underappreciated that these are the areas that was really important in order to secure investment. So do consider this when you're putting together your pitch. Sorry, bear with me a second. I seem to have lost my ability to change slides. So I've talked about where the equity markets were previously, but where are we at the moment? Back in 2019, the equity markets were just constantly growing, and then COVID happened. You know, as this graph shows, that the number of deals and the investment values over the years had increased. You know, from under 100 million, sorry, from under 100 deals to just under 500 deals at the early start of 2020. Some of these slides are from PitchBook, and they show that since the pandemic hit, globally, the venture capital markets have been hit really badly, and specifically within the UK. As you can see from some of these graphs, and especially the VC investment post-lockdown, the third graph, you can see that we've just had in the UK under a 50% drop in investment. Now, look, this particular graph is looking at those early stage equity markets, and as we would expect, that these have been hit significantly in 2020, and you know we're really down to those levels that were back in 2018. I think if we were to get really up-to-date figures on this, I think we'll probably see that those figures are even lower today. However, saying that, whilst the number of deals have fallen, the amounts raised seem to have held up. What this does tell us that though there are fewer larger deals happening, where there are deals happening, you know, they are still there. So, sorry, just to reiterate that, the amounts that have been raised have held up. So where those fewer larger deals happening, the amounts raised are still there. Okay, so this next chart shows who's been hit the hardest. And it really is, it's those investors who are coming around first time. It says businesses that are coming around first time. The investors appear to be protecting their portfolios. And where they've been investing, it's into those companies that they've already got investments in. And they're following up with more funding there. And as they can see that those particular companies are having trouble. As we all know, it's a very challenging environment out there. The Future Fund has helped a little bit, as that was set up with the requirement for previous investment. So though it's helped those businesses that have already been invested in, it's helped that money keep flowing in there. But unfortunately, it hasn't helped those first-time fundraisers. So within the UK, the seed and venture stage rounds still remain very, very low. And we do find within the UK that the SMEs are horribly undercapitalised. They just don't have enough capital, and we see that coming through in a lot of the loan applications that we've had come through in the recent competitions. I just wanted to share this information as well. The UK SMEs raise significantly less investment than the US counterparts. And there's an important role for the British patient capital to try and address this balance. You can see in this particular graph, the pink areas are the UK and the green areas are the US. And the average deal size for the UK totaling around 66.5 million, whereas the total for the US is just under 150 million. We have a similar proportion of companies receiving that follow-on funding at each stage as the US, but the amount of capital received at each funding round is much larger in the US. And I think it ranges from sort of 1.5 times at earlier rounds to 2.4 times at the 5th funding round. So let's look at investment readiness. When businesses are looking for equity investment in particular, they need to be ready. Typically, they'll sort of say, I need some money. But so often, they actually need more than they think they're going to need. So make sure that you do get investment ready. Take the advice, coaching, the specialist services that are out there to get investment ready. Through Innovate UK, we've got our Innovate UK Edge advisors. Used to be the Enterprise Europe network, but they're there to help and support you to get investment ready. As well, there's advice from the incubators, the accelerators, the various different growth hubs. And there's also a lot of support and available and specialist advice, including information through the UK Business Angels Association, the British Venture Capital Association, crowdfunding. They've all got really, really fantastic resources on their website. And as a business, you need to get better at articulating, who you are, what you're doing, what the opportunities are, and why you are a good match for the investor that you're looking for. And I think showing that you've been supported by Innovate gives you that sort of edge, and those private sector sort of innovative funders gives them some confidence that, Innovate UK believes in you as well. Just looking at some of the information available out there, there are some really, really good resources online. I just wanted to mention the Business Finance Guide. That's produced by the British Business Bank and the Corporate Finance Faculty of the Institute of Chartered of Accountants in England and Wales, and it's been supported by Innovate UK. It's a really fantastic, simple resource about where money comes from, and I believe there's an online version available on the British Business Bank Hub as well. Okay, just a couple of things I just wanted to add some information about. I wanted to mention the business sort of model generation and the business model canvas. I mentioned in the presentation that a business needs to know what their value proposition is. How are you going to deliver that proposition? How are you going to make money? Obviously, that's going to be by having more revenue than costs and leading to profitability. Here's here's some areas really that are worth considering and putting together your business model generation. So looking at your key partnerships, the core structure, key resources, key activities, looking at your financial structure, where your revenue is going to come from, your marketing, your customer segments, your relationships, and obviously the channels as well. But I just thought that this would be quite a nice slide just to include so that you can consider that business proposition, the business model generation as well. And it's really important for innovative businesses to be able to talk not just about how wonderfully shiny your piece of kit is, but you need to talk about why and what is the point of it. How does that turn? How does that sort of shiny piece of kit turn into that value proposition for the customer who's going to be paying for it? So it's really, really key, and it's about delivering. So it's about creating, delivering, and then capturing the value from that innovation. Try and think broadly. Think sort of psychologically and emotionally. What's that pain point? And what is the solution? What solution is it providing for your customer? And not just the job that it will do. So yeah, as I said, it's a promise of value or reward that customers will experience by selecting your innovation. So yeah, so how does your innovation meet your customer needs? Looking at those product services, pain relievers, pain and gain. And as I said earlier, what are their pain points? What is it going to answer for them? And what are they going to gain? So align your innovation benefits precisely to those particular areas. So in conclusion, I hope that I've been able to give you an idea of a finance escalator that starts at the bottom, goes to the top, is really somewhat fictitious. It's more like a game of snakes and ladders. Innovate UK really wants to support highly innovative businesses, those really risky ones. And it's that innovation risk that we are more prepared to take than maybe the commercial lenders will look at. We want to support those businesses that need risk capital, particularly equity investment. And what we're looking to see in our applications, and I think this is what investors will be looking for as well, that you've got a really strong technology development strategy, that you've got a strong commercialization strategy, all underpinned by your funding strategy. Without these, you're not going to be able to make money. There won't be that impact on the economy that we're looking for. And I do appreciate that this is probably how it feels for innovative business, and especially at the moment where we're going with the pandemic. I've included a list of really useful links, which I hope will help you to locate some of the information that I've provided for you. I've probably whittled through this presentation, and I apologise. It may be a little bit of death by PowerPoint, but there were some slides and things that I really wanted to share with you. Innovate UK, if you want to know more about our competitions, they're all available on our website, which is available, is on this particular slide. And what I would say, if you're looking to apply for anything through our competitions, please read the instructions. I appreciate that there is a lot of information that's provided, but it's there for a reason. And we often, especially on the loan side, get a lot of questions or a lot of applications coming through who don't get through the eligibility criteria because they failed to complete one part of the actual application form, even though it's been within the instructions that are there. Okay, I'm sure you're probably a bit fed up of hearing my voice now. So I'm going to say thank you very much for your time this afternoon. I really hope that I've been able to answer some of the questions that you may have, and I'll try and answer anything that now has been raised within the chat. Have a lovely, lovely day today. And once again, I really want to thank the team for inviting me to present. Thanks ever so much. Okay, so let's look at the questions that have come up. Okay. So one of the questions is, investor partners aligned with Innovate UK sound fascinating. Who are they? How can we access them? Do they have direct access to applications? If not, why not? We have a program called Investor Partnerships that's been set up, and yeah, Bruce Colley is running with that. So what I can do is I can provide you with Bruce's contact details, and do please contact him, and he'll be happy to tell you more about the investor partnerships availability. Next question, and we're a small software company and have built a business dashboard performance management platform, seeking loan or grant funding for the next phase of research development and accelerate business growth. Advice organisations that we should approach, please. Steve, I think it'd be really good for you to approach Innovate UK Edge, because they'll be able to look at what funding is around and how they'll be able, what other support is available. Okay. So brilliant. That seems to be the questions. Let me just provide you with Bruce Colley's email address so that you can contact him. Apologies whilst I just type this. Or, as I said, or you can actually just contact me directly if you've got any questions afterwards. Oops, sorry. I should be bruce.colley at Innovate UK. Please ignore that one. I'm going to type in the right one. Maybe I should have turned my camera off. Right, there you go. This is the correct email address. So I hope you've all had a good morning, and we'll be attending some of the other sessions later on today. But once again, thank you so much for all your time, and good luck with your raising investment finance. Thanks very much. Bye-bye.
Thank you for joining the Emerging Tech Fest. Join us again on our virtual live sessions, or watch us on playback anytime, anywhere.